Welcome to the Deep Dive, your essential shortcut to being well-informed.
Glad to be here.
Today, we're doing a deep dive into RB Global's Q2 2025 earnings conference call. Now, this is an interesting one.
It really is.
They're an omnichannel asset transaction platform, and they've been navigating some pretty choppy economic waters lately.
For sure.
They just presented some really interesting results and strategic updates. So our mission today is to unpack not just what happened, but why it matters.
And what it might mean looking forward.
Exactly. What management's outlook could mean for you, the listener, for the rest of the year.
Well, RB Global certainly delivered a strong second quarter overall. They actually surpassed analyst expectations on multiple fronts.
Okay, so strong performance then.
Yeah, looking at the big picture, adjusted earnings per share soared. Revenue saw significant year-over-year growth, and their gross transactional value, GTV, that also climbed impressively.
And the market reaction.
Pretty positive. It reflected optimism about the company's, underlying performance and strategic direction, even though, as we'll get into, there were some nuances below the surface.
Right. So with that overall positive sentiment, where did RB Global really shine when we drill down into the numbers? What were the standout figures?
Okay, let's get right into it. On an adjusted or non-GAAP basis, which, strips out certain non-cash or one-time things for a clearer operational picture.
Right. The underlying business performance.
Exactly. RB Global reported earnings per share of $1.07. Now, that's a solid 14% increase year over year.
14%. Wow.
And it significantly beat what analysts were expecting. Their revenue came in at $1.186 billion. That's an 8% increase year over year, also outperforming.
Okay, so beating on top and bottom line then, adjusted.
Correct. And their adjusted EBITDA, that key measure of core operating profit, grew a healthy 7% to $364.5 million.
And the margin?
Maintained a strong margin, approximately 30.7%. So what you're seeing here isn't just growth, it's efficient, profitable growth.
Those numbers certainly paint a very positive picture. But I noticed, while the adjusted figures were indeed strong, the GAAP earnings per share was 53 cents. That was actually down 2% year over year.
Mm-hmm.
Does that divergence between GAAP and non-GAAP give you any pause? What should our listeners take away from that detail?
That's an excellent question, and definitely something sophisticated investors look at. This divergence is primarily due to non-cash items, things like amortization from past acquisitions, and also a specific one-time loss related to a joint venture we'll probably touch on later.
Right.
So while the headline adjusted numbers are robust, this gap difference highlights that they are actively managing their portfolio, integrating deals, which can create some noise in the reported earnings.
So less about operational weakness, more about strategic moves.
I think that's fair. It's more a reflection of strategic restructuring. Now, the operating margin did also see a slight compression, down to 15.9% from 18.4% year over year. Some analysts noted that. But, given the context of these strategic adjustments and the overall positive performance elsewhere, it was largely overshadowed by the strong beats. It's really about looking at the full picture.
That context is definitely key.
Mm-hmm.
So beyond the top line numbers, let's dig into the actual segments. Where did they see the strongest activity and where were the headwinds?
Well, the automotive sector was undoubtedly the star performer this quarter. It showed some really impressive momentum.
How so?
Unit volume in automotive increased by 9% year over year. And that was driven by, a combination of strong organic growth and market share gains, both for salvage and remarketed vehicles.
And buyer interest.
What's really encouraging there is that their active buyer base is expanding. That indicates growing demand for these assets, and the company's multi-channel auction format, it continues to drive premium price performance. That speaks to the value they're creating for sellers.
And on the pricing side, within automotive, what did we see there? And what about this total loss ratio you sometimes hear mentioned?
Good point. Salvage values and U.S. insurance average selling prices, they actually increased by about 1% year over year.
Just 1%?
Yeah, that 1% increase might seem small, but it's actually pretty crucial. It suggests that despite broader economic pressures, the underlying value of these damaged vehicles is holding firm.
Okay, like a stable foundation.
Exactly. It provides a stable foundation for their core salvage business, almost like a hidden buffer in their asset valuation. Now, regarding the total loss ratio.
Right. What is that exactly?
That's the percentage of insured vehicles deemed uneconomical to repair after an accident. They get totaled and enter the salvage market. We saw this ratio increase by nearly 70 basis points in Q2.
70 basis points, so 0.7%.
Correct, up to roughly 22.2%.
And what does an increasing total loss ratio actually mean for RB Global? Is that good or bad?
It sounds counterintuitive, but for RB Global, this is actually a positive trend. A higher total loss ratio means more insured vehicles are being totaled.
So more supply for them.
Precisely. It directly translates into more inventory opportunities for RB Global within that salvage market. It fuels their supply side and ultimately their transaction volume. It's a key driver for automotive.
Okay, so automotive's strong. What about the other side?
Well, if we pivot to the other side, in contrast, the commercial construction and transportation segment, or CCNT, that experienced some softness.
How soft?
GTV and CCNT decreased by 6% year over year, and lot volume saw an 18% decline.
18%. That's quite a drop. What's driving that?
Management attributed this mostly to the cautious macroeconomic environment. Higher interest rates, evolving trade policy uncertainty. It's leading customers to take a wait-and-see approach.
That wait-and-see dynamic.
Yeah.
It feels like we're hearing that a lot. Is it just rates, or are there more to it? And how much is this comparable to last year? I remember there was something unique then.
That's a critical distinction. You're right. It's important to remember last year's CCNT performance benefited from unique factors, most notably the Yellow Corporation bankruptcy.
Ah, yes. That brought a huge volume of assets to market.
Exactly. So that made the year-over-year comparisons particularly challenging this time. If you actually exclude the Yellow Corporation impact, unit volumes would have declined only about 2% year over year.
Okay, 2%. Still a decline, but much less dramatic.
Right. And to your point on structural versus cyclical, management's conservative tone suggests they see it as primarily cyclical right now, driven by that economic uncertainty.
So their challenge is?
Their challenge is to really prove their value proposition for asset disposition, even when buying demand is a bit subdued. Maybe emphasize how they optimize recovery, even in a soft market. They seem to be working on that.
Makes sense.
Oh.
Okay, switching gears to strategy. Beyond the numbers, what significant moves did RB Global make this quarter to position themselves for future growth?
Well, on the strategic front, they made several pretty significant moves, signaled a clear path forward, I think. First, they successfully closed the acquisition of JM Wood. That's an Alabama-based heavy equipment auction business. Cost about $235 million plus $8 million of inventory.
JM Wood, so strengthening their position in heavy equipment.
And geographically, it significantly enhances their footprint and seller relationships, specifically in the U.S. Southeast, gives them a stronger regional presence there. And management explicitly said they have continued appetite for similar tuck-in M&A.
This focus on tuck-in M&A, that's not just about getting bigger, is it? It feels like a strategic choice. What's the advantage there?
Absolutely. It's strategic. By integrating these smaller, specialized businesses like JM Wood, RB Global deepens its competitive moat, you could say.
How so?
They strengthen their local networks, they gain proprietary data on specific regional markets and asset types, and they enhance their specialized expertise. It just makes it harder for competitors to replicate their full omnichannel ecosystem.
Creates a stickier platform.
Exactly. A more robust and sticky platform for both sellers and buyers. It's a smart play for long-term dominance, I think.
Okay, what else on the strategic front?
Another notable development is this new joint venture they established with LKQ Corporation over in the UK.
LKQ. Okay, what's the structure there?
Essentially, RB Global deconsolidated its LKQ Synetic automotive parts and dismantling business. Think of it like they spun off a chunk of their UK auto parts business into this new JV with LKQ.
But they still have a stake.
Yeah, they kept a significant 40% stake in that new entity. But crucially, they retained 100% of the salvage auction part of that UK business. That now operates as IAA in the UK.
So they're trimming inventory exposure, focusing on the fee-rich auction services. Sounds like streamlining. Was there a financial hit from this?
Precisely the goal. Trim reported inventory on the balance sheet, sharpen focus on those higher margin, fee-rich services where they aren't holding the assets. There was a one-time loss of $19.7 million recorded with the deal.
Okay.
But the company doesn't anticipate a material impact on top-line revenue or overall profitability for the rest of 2025. So, yeah, more strategic realignment than a major financial event for the ongoing business.
International expansion is another big theme we're seeing everywhere. How's RB Global approaching that?
Yeah, they touched on that too. Management announced the IAA Australia rollout is progressing well. Actually, they expect the first set of cars for sale there to be processed within just 10 days of the call.
That's quick.
Very quick. And this is seen as a prime example of their broader international growth strategy. Establish the infrastructure now for future market share gains in key global markets,
Yeah.
building the pipes for future volume.
And, as a company dealing with assets, especially vehicles, that can be affected by natural disasters.
Yeah.
What did they say about their readiness for catastrophic events, CNT events? Do those factor into their guidance?
Right. That's an important question for a business like theirs. They did highlight their preparedness. They emphasized a proven and scalable model for response, leveraging partnerships, and their extensive network of Ritchie Bros yards.
So they feel ready.
Seems so. Crucial for their salvage business. They also clarified, though, that their guidance does not incorporate any contribution from SAT-related GTV. It's just too unpredictable.
Makes sense. But it can be significant when it happens.
Oh, yeah. They noted SAT volumes contributed about $169 million in automotive GTV back in Q4 2024. So it can be a nice, albeit unpredictable, boost. They also mentioned seeing no notable impact from uninsured motorist trends.
Okay. Now, a key metric management often emphasized was the service revenue take rate. What exactly is that, and what did we see there this quarter?
Yeah, the take rate. It's basically their earn rate. It's the percentage of the gross transactional value, the total value of stuff sold, that RB Global keeps as revenue for the services they provide.
And how did that look?
It increased this quarter, up 20 basis points year over year to 21.1%.
20 basis points. 0.2%. Doesn't sound like much.
Well, when you're dealing with billions in GTV, it adds up significantly. This expansion was primarily driven by a higher average buyer fee rate structure.
So they're charging buyers a bit more on average.
Effectively, yes. And management views this as a direct reflection of the value-added activities they provide across the whole transaction lifecycle. They sounded pretty confident in the sustainability of these trends for the rest of the year. And if we connect this to their bigger picture strategy, RB Global's enterprise strategy really focuses on driving what they call blended net recovery for their partners.
Blended net recovery. Okay, break that down.
It means offering services across multiple channels, auction, wholesale, even retail, to find the best possible financial outcome for a seller for that specific asset. And also getting upstream with partners.
Getting upstream, meaning getting involved earlier in the process, before it even hits auction.
Exactly. Becoming more integrated with their partners' asset management and disposition processes from the start. It's about being a comprehensive solution, not just an endpoint auction house.
And what other avenues are they exploring to add value around the transaction?
They're exploring initiatives like Boom and Bucket. They noted strong performance from their MPE channel for quick liquidation. And they also discussed their financial services, RBFS.
Right, financing option.
And their transportation services, VeriTread. These are ways to add value around the actual transaction. Now, RBFS attach rates might be influenced by the current interest rate environment. That's logical.
Sure.
But VeriTread, the transport piece, that holds significant growth potential. Moving heavy equipment or salvaged cars is a huge logistical challenge, right? So helping with that adds real value on both the buy and sell sides.
Makes sense. So looking ahead then, how confident is management feeling about the rest of the year, given these dynamics? Did they update their guidance?
They absolutely did. And in a way that signals confidence, I'd say. RB Global updated and tightened its guidance for fiscal year 2025.
Tightened and raised.
They expect adjusted EBITDA now to be in the range of $1.34 billion to $1.37 billion. So yes, they actually raised the midpoint of their previous guidance range.
Interesting, despite the CCNT softness.
Yep. Exactly. Now, GTV growth is expected to be at the lower end of its previous range, but that's mainly because they're excluding those unpredictable CT events we talked about.
Right.
So the updated adjusted EBITDA guidance reflects management's confidence in profitability, even with those ongoing macro uncertainties, particularly in CCNT. They also set a tax rate of 24-27% and CapEx between $350 and $400 million. Now, management definitely adopted a conservative tone for the second half, especially concerning CCNT. We know it's facing headwinds. But they did express cautious optimism for a gradual improvement in momentum into Q3.
Okay, cautious optimism. Any other signals of confidence?
Oh, yes. A very strong signal, actually. Confidence in cash generation and sustainable long-term growth. They declared a 7% increase in their quarterly dividend.
A dividend hike.
In this environment.
Exactly. Raising it from $0.29 to 31 cents per share, payable in September. A dividend increase like that really speaks volumes about their view of the financial health and their commitment to shareholder returns. And the market's reaction certainly seemed to underscore that confidence, didn't it? How did investors respond?
Very positively. Following the call, RB Global's stock price jumped over 2%, and trading volume surged up about 94% compared to its 3-month average.
Huge volume spike.
Yeah, suggests significant investor interest and buying activity. Plus, analysts at places like RBC and Raymond James subsequently raised their price targets, signaled bullish sentiment driven by those strong financial beats and the steady outlook.
And longer term.
Well, over the past year, RB Global has significantly outperformed both the broader market like the S&P 500 and the industrial sector ETF. It really showcases their resilience and strategic execution in what's been a challenging backdrop. They are truly standing out.
Fascinating insight so far. Okay, let's shift to our not financial advice segment.
All right, let's state it clearly. This is not financial advice, purely a thought experiment, pushing the boundaries of what's plausible, maybe even a little audacious.
Okay, got the disclaimer. So given RB Global's strong automotive segment, the strategic M&A deepening its moat, that dividend boost signaling confidence, but still navigating that cautious CCNT environment, what's a potential trade idea that might capture these dynamics for, say, an institutional investor?
Okay, here's one way to think about it. Consider a long position in RB Global, ticker RBA, paired with a short position in a basket of, say, commercial real estate companies or maybe heavy equipment rental companies.
Okay, long RBA, short CRE, or equipment rental.
Yeah.
Why that specific pairing? What's the rationale?
The rationale is this. RB Global's diversified model, its focus on that blended net recovery across channels, and its proven ability to manage asset dispositions effectively, even in a slow or wait-and-see environment, it positions them defensively, but still with growth optionality.
Right, they thrive on the transaction itself.
Exactly. The dividend increase gives you a tangible return while you wait. Those tuck-in M&A deals could unlock further synergies. So the long RBA side lets you capitalize on the secular growth in automotive, benefit from their operational execution.
And the short side?
The short side acts as a hedge. You're shorting companies potentially more acutely exposed to that lingering CCNT weakness or higher interest rate sensitivity, things like commercial real estate facing vacancy or rate issues, or equipment rental firms suffering if construction slows down more sharply.
So you potentially profit if those sectors continue to face headwinds while RBA holds up due to its model.
That's the idea. It's about leveraging RB Global's unique ability to thrive on asset transactions and facilitating market liquidity. Whether the underlying market for new stuff is booming or consolidating, they make money on the movement, not just the ownership.
Very interesting thought experiment. Okay, that wraps up our deep dive into RB Global's Q2 2025 earnings. Clearly demonstrated strong operational performance, especially in automotive, and some smart strategic foresight while navigating those CCNT challenges prudently.
Definitely. Their tightened guidance and that dividend increase really underscore management's confidence in profitability and long-term value creation. Even with that conservative outlook for the back half of the year, they are playing a long game, and it shows.
As always, this information is purely for educational purposes, absolutely not financial advice. We strongly encourage you to do your own research and due diligence, but maybe consider this. In an increasingly uncertain economic landscape, how might companies that specialize in facilitating asset transactions, optimizing their movement and recovery rather than just holding assets, how might they be uniquely positioned for sustained growth and resilience? Something to ponder.
Indeed. Thank you for tuning in. We look forward to our next deep dive.